Hi, good evening, everyone. We will start I think we can start now. We have a few attendees. Okay, so a very good evening and a warm welcome to everyone present. Today, we welcome you all for the webinar with the CME Group. And I take this pleasure to introduce to you our guest speaker for today, Mr. Erik Norland. Along with Mr. Erik, we also have the team members of APM Capital Limited. Before beginning with the webinar, we would like to SEO, Mr. Nick, to give you all a short introduction about APM Capital Limited. Over to you, Nick.
Hey, good evening, good afternoon, everybody. Yeah, I'm Nick Spencer-Skeen. I'm the SEO of APM Capital, and we're delighted to welcome you to our second webinar in conjunction with the CME Group. So APM Capital is headquartered in Abu Dhabi. We're authorised and regulated by the Financial Services Regulatory Authority in the Abu Dhabi Global Market, ADGM. And having only started our journey in May 2021, it's a great honour to be working alongside our friends at the CME Group. So I'm going to keep my piece really short because Erik's got lots to say to us tonight. So once again, we welcome Erik Norland, and without further ado, I'd like to ask Hitachi to make an introduction. I hope you all have some great takeaways from this session this evening, and hopefully see you at the next one. Hitachi.
Thank you, Nick, for the amazing introduction. So before starting with the topic of the day, equities, let us give you all a short introduction about Erik. So Erik Norland is the Executive Director and Senior Economist of the CME Group. He is responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting their impact on those who trade in its various markets. He's also one of the CME Group's spokespeople on global economic, financial, and geopolitical conditions. In fact, prior to joining the CME Group, Erik has more than 15 years of experience in the financial services industry, and he works for investment banks and hedge funds in both the US and France. He holds a bachelor's degree in economics and political science, and he is a MA in stats from Columbia University. He's also a CFA Charterholder. Also, we are very lucky to have these webinar sessions with the CME Group and Erik. Now, I would like to hand over the stage to Erik. And in case you all have any questions during the webinar, there's a question answer box on the top of your screen. So you can add on your questions there. And at the end of the talk, we'll have a question answer round where Erik will be answering all your questions. Over to you, Erik.
Hi, yes, thank you so much for the introduction, and thank you all so much for being here on what for most of you I think is your Friday evening rather than your Friday afternoon like it is here in London. Let me begin first by sharing the slide deck. Hopefully this is going to work. I'm going to put it into slideshow mode. Here we go. Yes, here we are in slideshow mode. Can everybody see it? Is it coming through okay?
Yes.
Okay, great. Yes. So thank you so much again for joining us. It's a great pleasure to be here with you once again to talk about the macroeconomics of equity markets and how it relates to the equity market. And this is, of course, a very, very exciting time to be addressing this subject because yesterday, as I'm sure you all saw and experienced, the equity market had a gigantic rally. A rally of around 6% on the S&P. It was the biggest up move we've had in several years. Probably among the biggest up days ever. But there's a lot to unpack here. So why did the up move happen? Why does a 0.2% surprise on the inflation number in the United States generate this seemingly kind of oversized reaction? What does this mean for the markets? We'll address those questions. We'll also take a look at longer term issues, kind of like where we are in the market cycle. How does the market relate to the economy? What's the outlook for inflation itself, which is what produced this enormous move in markets yesterday? And we'll, in that context, be talking about employment, the various components of inflation, what's happening outside of the United States and China and in Europe. And then lastly, we can kind of move on and talk about different sectors of the market, like small caps versus large caps, trading between, say, the Russell 2000 and the S&P 500, what's going on with technology stocks. And we can also look at some very weird and interesting market cycles that I think you've probably not seen before. So before we begin, I do have to show you both this short, succinct version of CME's disclaimer, as well as the longer and more detailed version of CME's disclaimer, which would basically say that because CME is an exchange operator and not a broker-dealer or an investment bank, we are unable to offer you any financial advice. So no financial advice is given or intended. With that in mind, what we saw yesterday was this gigantic up move, right? Like one of the biggest single up days we've seen in a long time. But when you look at it in a broader context, it doesn't really register very much, right? So where we are is in this, this is comparing the current market cycle. We're in a bear market for the stock market, which began, depending on which index you look at, either at the end of December or the very beginning of January this year. So we're about 200 some odd trading days into this bear market, about 220 trading days or so into this bear market. And what's very interesting so far, I think, is how similar it looks to the previous two major bear markets. The one that took place from 2000 to 2002, and the one that took place from 2007 to 2009 during the global financial crisis. And those bear markets are also messy. They had huge, huge rallies that took place during them. So yesterday we had this gigantic up move in stocks. But one thing I've been warning people about over and over again is that the biggest up days in history all occur during bear markets. Why is that? It's simple. It's because bear markets are just extremely volatile. And also during bear markets, you have some people who go short the market through futures contracts or, in the physical equity market by borrowing stocks and short selling them from security lending desks. And when those trends reverse, everybody gets caught short and they have to cover those shorts by buying futures or by buying back the shares that they short sold in the equity exchanges themselves. Is that I think largely what we had yesterday. So we had this huge up move, but I would warn you not to get too excited by this. It could be that this is the end of the bear market. It could be that this is a turning point, or it also might be that that's not the case. And so we'll kind of explore what the probabilities there are. But before we get there, though, I do want to talk about what caused this huge up move in equities yesterday and why it is that equities are so sensitive to inflation. So part of the issue is that the equity market does not exist in isolation. The equity market is very, very deeply connected to the fixed income market. So bonds and equities are almost like two sides of the same coin. And it's really hard to understand the equity market without understanding the fixed income market. And the same is also true in reverse. It can be hard to understand the bond market without understanding what's happening in equities. But we are now, I think, in a very different period. As we'll discuss further in the next slide, the last decade was a beautiful decade for the lazy portfolio manager. I know this sounds mean, calling people lazy, but what I mean by the lazy portfolio manager is a sort of classic portfolio where you put maybe half of your capital in stocks and half of your capital in bonds. And so the reason why it was such a spectacular decade is very simple. Stock prices, as you see on the left-hand chart, soared. You had just massive gains in the NASDAQ 100, the S&P 500, the Russell 2000, just huge, huge up move in the stock market. But secondly, as you see in the right-hand chart, we also had a really big upside move in the bond market as well. Bond prices over the course of the last decade roughly doubled at the long end of the yield curve. So stocks and bonds both went up. But there's one thing more that's not really visible in these charts that we'll see in a second, which is that during this beautiful up move in stocks and bonds, stocks and bonds on a day-to-day basis actually had a negative correlation. That meant that if you were long stocks and long bonds with a negative correlation, not only were they going up, but they were going up on different days. So on days in which stocks are up, bonds are usually down a little bit. And on days in which stocks fell, which they did sometimes even during a bull market, the bond market typically went up a lot. So investors got this spectacular risk-adjusted returns. But now, as you can clearly see on the right-hand side of these two charts, something else has happened. The stock market has started to decline, and the bond market has also been declining. And that negative correlation has now flipped back positive. And so you see here on this left-hand chart the correlation between stocks and bonds. What you see is a couple distinct periods. From 1984 until 1998, stocks and bonds were mostly positively correlated. So on days in which the stock market went up, bond prices also typically went up. And on days in which bond prices went down, stock prices typically went down. So that was problematic for investors back then because there was not a lot of diversification. If you owned stocks and bonds and they were doing the same thing, they really weren't diversifying each other very well. And so why was that? Well, the primary reason is that before 1998, investors were very, very afraid of inflation. We had extremely high inflation in the United States, for example, and in Europe, and in Japan and many other countries from the mid-1960s to sort of the mid to late 1980s. And when inflation finally came down, it took a long time for the market psychology to change. But it did eventually change. And in 1998, we had a financial crisis, a sort of very minor one. But Russia defaulted on its debt. We had a financial crisis in Asia, and a New York-based hedge fund called Long-Term Capital Management collapsed. And suddenly, it brought to the market's mind that it was possible to have a financial collapse. With banks collapsing, et cetera. Now, in this case, it got resolved quickly. The Federal Reserve kind of bailed out the hedge fund and the banks. The hedge fund was wound down in an orderly fashion. But then shortly after that, we had a recession in 2001 and 2002, and a correlation between stocks and bonds became very, very deeply negative. And it kind of stayed there again after 2008, really for the next 12 years. And the reason was the markets were no longer afraid of inflation. They were now afraid of deflation. They were afraid of financial collapse. And when financial collapse happens, you typically sell equities and you buy bonds. And then when financial collapse seems less likely, you may sell your bonds and buy back stocks. But in any case, it had this beautiful negative correlation. So if you look at this right-hand chart, you see in this sort of black color, you see the risk-adjusted return of the S&P 500 over the last decade. So we calculate that by taking the average daily return of the S&P and multiplying it, by 250 to annualize it. Then we divide that by the standard deviation of the S&P 500. So we create essentially what's called the information ratio. So the information ratio of the S&P 500 over the last decade has been like 0.6, which means you basically get 0.6 units of return for every 1 unit of risk that you put into the market. And the darker of the two blue colors, you have the U.S. long bond, so the U.S. long-term U.S. Treasury. And its risk-adjusted return has now been taking this nosedive towards zero. But when you have a 50-50 mixed portfolio, you have the light blue line. As you can see, back in the 80s and early 90s, there really wasn't that much diversification. Like a mixed portfolio didn't really do that much better than owning treasuries or owning equities individually. But then suddenly, as that correlation became negative, the mixed portfolio suddenly prospered. It got these incredible risk-adjusted returns for a decade. But now all of this is nosediving. So institutional investors that have these portfolios have been in a lot of pain because their stock and their bond portfolios are not only doing badly, they're doing badly at the same time. So a lot of investors, I think, are looking for alternatives. They're looking for long and short strategies. They're looking for hedge fund strategies and other things that can diversify them. But let's talk about yesterday. a little bit more, and inflation. So yesterday we got the CPI number. It surprised 0.2% on the downside. So you look at this and like, oh my God, you can barely even notice, right? So it came in at 7.7 instead of the expected 7.9, but it's still extremely high. And the core number came in at 6.3% rather than the expected 6.5%, which is also still extremely high. So you have to really wonder to yourself, why is it that the equity market had this sort of crazy reaction yesterday where it had this massive, massive rally? And I think that was very much a short covering rally where people had to get out of very negative positions on stocks and bonds simultaneously because both markets started to move upward. But the markets did change their pricing. When you look, for example, at the expectations for how far the Federal Reserve might raise rates, the market now expects the Fed will hike only 50 basis points in December instead of 75, which it had thought previously. Maybe only 25 basis points in February rather than 50 basis points, as some had thought previously. So basically, this means a less positive trajectory for interest rates, and that's good for stocks, because we'll see in a moment. The equity market, in theory, takes future earnings and discounts them into the present. So the lower interest rates are, the more positive that is for the equity market. But we also have to ask a few questions about inflation. So yesterday we had this better than expected number. We had a huge rally in stocks, but what should we really think going forward? Because this is not the last CPI number we're ever going to get. We're going to get another CPI number in mid-December, another one in mid-January, another one in mid-February, et cetera. And so what happened yesterday is not sort of a definitive end to the history of inflation. So one of the biggest components of inflation is something called rent, or owner's equivalent rent. Now, when we measure inflation in the U.S., it measures all sorts of different goods and services. So part of the reason why it surprised on the downside yesterday was that certain things have seen falling prices. So last month, for example, medical care prices fell by 0.5%, which, by the way, I think will never happen again. It was just some sort of statistical fluke and quirk, and it's going to go back up next month. We also had declining prices for airfares. That, I think, is a delayed reaction to falling oil prices. So that's probably not going to happen again either. We also saw declining prices for things like used cars and used trucks. And that maybe will continue a bit. But when you look at the biggest single component, the biggest component is housing. And so housing is 30% of CPI. And it fits into two categories. The first category is really simple and really straightforward. It's just the cost of rent. So that's about 7% of the index. The second one is a bit more abstract. It's 23% of the index, and it's called owner's equivalent rent. So what owner's equivalent rent is, you kind of have to use your imagination here, but imagine you own a house in the United States, and your neighbors rent their house from, say, some other owner. And say that their owner hikes their rent by 10%. So then the government, statistical agency, is going to say, okay, well, your neighbor's rent went up 10%, so therefore you are renting your house from yourself, which I know is crazy. Nobody rents a house from themselves, but this is how they calculate it. So anyway, you rent your house from yourself, and now your rent that you're paying to yourself is now 10% higher, which I know is nuts, but that's how they calculate it. So look what's happening to rental costs here in the dark blue. They're soaring. They're rising at 7% year on year. What's really disturbing about this, for anybody who hopes that inflation is going to come back down quickly, is that the cost of renting typically follows the cost of buying, which you see there in light blue, but with a lag of 1.5 to 2 years. So we've had soaring prices to buy homes, but now mortgage rates have gone from 3% to 7%. So the buyer's market's starting to collapse in the U.S. But because people can no longer afford to buy homes, everybody is now going into the rental market, which is putting rents higher. And this is likely to cause the CPI numbers, despite last month's nice 0.2% surprise, to be very strong going forward. There are also other reasons to be concerned here too. First, vacancy rates in the United States for rentals are extremely low, only 1.5% vacancy rate. So not only are higher mortgage costs pushing people into the rental market, but they are also in a situation where there are not many properties available for rent. And so the prices are really starting to move. But this is not the only reason to be concerned. Another reason to be concerned that inflation is not really coming down in spite of last month's nice number is that unemployment is very, very low in the U.S. It's come back down to 3.7%, which is basically as low as it ever gets. So the jobs market is very, very tight. And you can see that here. Non-farm payrolls have now more than recovered from the pandemic. They are now above where they were in the end of 2019. But the difference, though, is that at the end of 2019, employers were looking to hire, this is on the right-hand chart, the JOLTS, the Jobs Opening and Labor Turnover Survey. Back then, before the pandemic, people were looking to hire maybe 7 million new workers. Now they're looking to hire 10.7 million new workers. I don't know where anybody can find 10.7 million new workers when you're already at full employment. So wages continue to increase very quickly. They're increasing at 5% per year. I think this is going to add a lot to inflation. Now, there is a counter argument. One of the counter arguments is that supply chains are easing. So the cost of shipping goods across the Pacific, for example, is coming back down. So that's good news. Part of the reason for that is that China's economy is doing really badly. China has huge, huge amounts of debt. 280% of GDP. That's far more debt than we have even in the United States or Europe relative to the size of our economies. Likewise, China's debt is mainly in the non-financial corporate sector. The non-financial corporate sector has to borrow money from banks and from the bond market, and yields on those Chinese bonds have been soaring as prices collapse. You can see here the market iBox USD China high yield total return index is down over 40% from its high, which means that bond yields are soaring. It's making it more difficult for China to finance all of its debt. China also has a really kind of overdeveloped property sector. So one thing that might happen is China's economy goes into a recession, and that depresses the cost of commodities. So you start seeing falling prices for oil and a whole bunch of other commodities, and maybe that takes a bit off of inflation. But there's another problem, though, that I think could cause inflation to go higher, and that's the level of real interest rates. So the Federal Reserve is super proud of itself now. It thinks it's done such a great job because it's gotten interest rates up to almost 4%. I mean, okay, that's nice. But the problem here is that inflation's at 6.5%. So that still means that the Fed has a negative 2.5% real interest rate with respect to core inflation, which means it's still subsidizing people to borrow money. And this, by the way, is not unique to the United States. If you look at inflation rates in Europe, the headline rates are even higher than they are in the U.S. And the core rates are, maybe not as bad in the Eurozone, but about the same in the UK. And so Europe also has massively negative real rates of interest like we've not seen since the 1970s. So central banks, you could argue, are still subsidizing people to borrow money. And until they get interest rates up higher, closer to the rate of inflation, it's not really clear how inflation comes back down. And like in any market, though, you have expectations about the future. And so expectations about the future are what drives equity and bond markets. So when you look at the inflation expectation for equities and bonds, what you see, or I should say for inflation expectations for the economy, rather, from the bond market, you can see that the bond market really thinks and really prices that inflation is going to come down very, very quickly. So when we had confirmation of that yesterday, we saw this big rally in stocks. But I don't know if that's going to continue. And so there's a couple of reasons here, I think, to be concerned. First, as part of its tightening of monetary policy, the Federal Reserve is reducing the size of its balance sheet. It is essentially doing a reverse quantitative easing or a quantitative tightening. When the Federal Reserve did all the QE, especially back in 2020, but continuing into early this year, it sent stock prices soaring. We wound up with much, much higher stock prices. Now that the Federal Reserve is shrinking its balance sheet, that is putting downward pressure on stocks. Another reason I think to be very concerned about the stock market, particularly in the U.S., is the level of valuation. The valuation levels in the U.S. are exceedingly high. They're still around 140% of gross domestic product. That's higher than they were at the peak in 2000, much higher than they were in the late 1960s. And what you also see in this right-hand chart is that there is an inverse relationship between the level of interest rates and the level of the stock market. When bond yields are very low, like they were during, say, the 1950s and 60s, or like they were during much of the last decade, the stock market can support very high levels of valuation. But when bond yields rise, as they have been rising recently, the stock market can no longer justify those valuations. And so there's two reasons for this. One, equity investors have a choice. They could stay with risky equities, or they could go to less risky bonds. So as interest rates rise, there's always a temptation to sell stocks and go into bonds. But in addition to that, though, there's also the theoretical reason, which is that the valuation of the stock market should be equal to the net present value of future cash flows. And the net present value of any cash flow varies inversely with the level of interest rates. When interest rates are low, the net present value for future cash flows is very, very high, and that's been the case in recent decades. On the other hand, when interest rates go higher, like they did during the 1970s and early 80s, the value of those the net present value of those future cash flows begins to shrink. But the reversal of quantitative easing, I think, is very, very dangerous for the equity market, because it's not just the Federal Reserve that's doing it. The Bank of Japan is doing it. The European Central Bank is doing it. The Bank of England is doing it. The Bank of Canada is doing it. And I think there's something about quantitative easing that's very, very addictive. It sends asset prices higher, so then when you reverse it, asset prices begin falling. And then as they fall, it can create a condition in which the markets begin to panic. And we saw that here in the United Kingdom in September with the gilt market. And then the central bank had to intervene and temporarily expand the balance sheet once again. But, very strangely, though, in the U.S., equity investors don't see a lot of growth going forward. So one of the really interesting indicators you can look at is our S&P 500 dividend index futures. And these were launched relatively recently. They were launched only back in 2015, but they give you a sense of what equity investors believe about the future. So there's a very highly valued equity market, but the equity market investors don't think we're going to have any growth in earnings in nominal terms, meaning in real terms, in not inflation adjusted terms, rather, during the next decade. If you look at it inflation adjusted, look at it in real terms, equity investors actually think corporate earnings are going to fall during the coming decade. And I think you really see this when you add up the next 10 years worth of dividend futures. So in the left-hand chart, we just look at the nominals. We're not inflation adjusting them. We're not adjusting them for interest rates. What's really weird about this is when you look back to the left-hand chart and you look over to the left-hand side of it at the beginning of 2017, the market was pricing about 540 index points worth of dividends would be paid in the next 10 years. So in other words, between 2017 and 2027. Okay, so you fast forward to today, and investors still think there's going to be 540 dividend index points worth of dividends paid in the next decade. But the price of the market, even in spite of its bear market, is still much higher. In 2017, when it was pricing that, the index was trading at like 2450. Now it's trading at 3950. So the market's gone way up, but expectations for earnings have not improved at all. And when you, on the right-hand chart, when you take these forward expected dividends and you discount them back into the present moment by using long-term bond yields, what you find is that the discounted net present value of of those dividends used to track the S&P 500 very, very closely until March 2022, when the Federal Reserve began all of this quantitative easing. And suddenly the S&P 500 diverged from the net present value of future dividends, and it rose far, far above the levels that it looked justified. It looks to me like the S&P 500 probably has a fair value around 2,900 points. And this is problematic because the index is currently trading at 3,950 points, which suggests to me that the index is probably about 1,000 points overvalued. Now, it's always very hard to say what's going to happen to it, but there is maybe a more positive case that has to do with the recent elections. In the United States, we had elections earlier this week. The election results in some ways were very surprising. The Democrats did much, much better than expected. But despite that, the Republicans still seem very likely to take over the House of Representatives. So when you look at the U.S. historically, there's been different possible regimes. You could have a Democratic president and a Republican Congress, like seems to be heading into. And during those regimes, the stock market's often done very, very well. You've often had this huge increase in stock prices. Part of that may be that it is a condition under which we tend to have a lot of fiscal conservatism. So there'll be no tax cuts, and there won't be any spending increases. And so that will reduce the budget deficit potentially, and potentially help the stock market to go higher. But we've only had two previous periods where we had a Democratic president and a Republican Congress in recent memory. We had it with Bill Clinton in the mid-1990s, and the stock market did really well there. You see that in the purple. And the same thing with Barack Obama after 2010 to 2016. But during those two times, the stock market began those two times with really low valuation levels. This time it's heading into a divided government with very, very high valuation levels. So it might not achieve the same results as before. But nevertheless, previous periods of divided government have typically produced lower bond yields, whereas periods of united government, when one party controls everything, like you see in the blue and the red, particularly the blue, you often wind up seeing much, much higher bond yields. So the election yesterday, I think, could have an effect. It may also have helped the market to rally a little bit yesterday. The markets, I do think, tend to like divided government. Bloomberg had their own study of this, where the stock market did better on average when there was a Congress of one party and a president of another party than it did when one party controlled everything. But budget deficits do tend to shrink, especially when you have this combination of Democratic presidents and Republican Congresses. The opposite, by the way, happens when you have a Republican president and a Democratic Congress. You tend to have much bigger budget deficits because, in that case, the Republicans get their tax cuts, the Democrats get spending increases. But in the political constellation that we seem to be headed into, the opposite usually seems to be the case. I also want to mention, just sort of briefly, that there can also be incredibly strong market cycles between different indices. So, for example, if you compare the S&P 500 to the Russell 2000 since 1979, I chose 1979 because that's when the Russell started. The two indices have done about the same. So the 500 stocks in the S&P 500 have done about the same as the 2000, much smaller stocks in the Russell. But when you look at the right-hand chart, you see the ratio between the two of them. And the ratio has huge, huge moves. So, for example, small cap stocks did much better from 79 to 83. They kind of doubled in value. And they did much better again from 1990 to 1994, and then again from 1999 to 2014. But large cap stocks did much better in the late 80s, the late 90s, and the late 2010s, including earlier this year as well. And so what happens there? What's going on? I think large cap stocks tend to outperform during the late stage of bull markets. When the economy is doing really well, Large cap stocks just sort of go on this big roll. But when you have an economy that's experiencing a lot of volatility, experiencing recessions and big changes, smaller companies seem to do better. And I kind of wonder maybe if we are heading into a period in which small cap stocks are going to outperform. The Russell 2000 has been a big outperformer in recent weeks, and it might really start heading higher relative to the S&P if we go into a period of economic turbulence, where small, nimble companies might outperform their larger, more bureaucratic, slower-moving peers. This is one last thing I want to leave you with. It's really weird, but it also talks about the connection between fixed income and equities. But this is not about the equity market in a classic sense, but rather about equity volatility, which you may know through the VIX index. So here on the left-hand chart, we have the shape of the yield curve, the difference between short-term and long-term interest rates. One thing you'll notice here is at the end of this chart, the Federal Reserve has raised rates a lot, and the yield curve has become very flat. It's gone back to zero. So basically, there's no difference right now between short and long-term interest rates. Typically, that could be a prelude to an economic recession. In an economic recession, small cap stocks often do better than large cap stocks. So the Russell 2000 might be a really interesting thing to look at over the next few years. So during periods of steep yield curves usually precede economic expansions. Periods of inverted or flat yield curves often precede economic downturns. On the right-hand chart, we have a chart of the VIX index, which is an index of options on the S&P 500. We have our own better version of it now at CME called CVOL. CVOL is a phenomenal index. It goes on all of our products. I highly recommend taking a look at it. But I'm using the VIX here because the VIX just has a really long history. It goes back to 1989. Our CVOL doesn't go back quite that far. But there is a cyclical relationship between the yield curve and volatility, and I'll show you what it is in a second. So this next chart I'm warning you is a joke. It's meant to be laughed at. I know it looks like a piece of modern art. But on the left-hand side here, we have the monetary policy, so basically the yield curve. Is if we just flip back here, then the x-axis is going to be the left-hand chart, and the y-axis is going to be the right-hand chart. Did I get that right? No, I messed that up. Sorry. The y-axis is the yield curve, and then the x-axis along the bottom is the VIX index, averaged out over 2 years. So I know this looks totally insane. You're probably like, oh my God, what's going on? This doesn't make any sense. This isn't helping me. But we'll break it into 3 parts and talk about it, and you'll see immediately that something is going on here. So let's get to this first chart here on the left. In 1990 and 1991, when this cycle began, we had a flat yield curve. So the Fed had tightened monetary policy, just like they have recently. They brought short-term rates up to the level of long-term rates, and the market was rather volatile. So kind of in the southeast corner here of this chart, and the economy went into a recession, and banks failed. The economy was going down, so the Federal Reserve cut interest rates. So by 1992 and 1993, they were steepening the yield curve, and the economy began a recovery. In 1994, the Federal Reserve said, okay, it's safe, we can begin hiking interest rates. So in 1995 and 1996, they flattened out the yield curve, and then we began to see a lot of problems in the economy. In 1997, we had the Asia crisis that I mentioned earlier. 1998, we had the long-term capital management meltdown. And by 1999, we wound up with a very, very volatile equity market and a very flat yield curve. So if you look at the right-hand chart in 2000 and 2001, again, we went full circle. So we started with flat yield curve, volatile markets. What happened? The economy went into a recession. As a result of the recession, the Federal Reserve slashed interest rates. That sent the yield curve much steeper. Eventually, volatility fell, and then the Federal Reserve began hiking interest rates a great deal in 2005 and 2006. So by early 2007, again, we had a flat yield curve, and we had very calm equity markets. But then, of course, we had this massive explosion. As the Federal Reserve tightened interest rates, it caused the banking system and the housing market in the U.S. to collapse. Well, now we have essentially gone full circle, but there's a little hitch here. So in 2009 and 10, the Federal Reserve cut interest rates to zero. We had a very steep yield curve. Over many years, volatility came back down. But then in 2015, the Federal Reserve said, okay, we're going to start hiking interest rates. They started raising interest rates. And then volatility by the end of 2018 and 2019 was starting to rise, and it exploded in 2020. Then as a result of the pandemic, as we saw earlier, the Fed cut rates to zero and did all this quantitative easing again. So that kind of temporarily halted the expansion of volatility. But what's happening now? Well, we know what's happened now is the Federal Reserve has already flattened the yield curve, and they are continuing to raise interest rates. So this is going to go straight to the bottom of the chart. What I think is going to happen is that we are also going to see an explosion of volatility coming up over the next 6-9 months, which leads me to believe, as I kind of hinted at the beginning, that we are nowhere near the bottom of this bear market. I don't care if the equity market rallied 6% yesterday. Inflation isn't going away that quickly. There are more negative surprises to come. The Federal Reserve may over-tighten policy. It may put the economy into a recession. And again, be warned, you're going to see a lot of huge updates now and again, just like you always do in bear markets, because the biggest updates that we've ever had have almost all occurred in declining markets. So I think that the U.S. economy is likely going to go into a recession sometime in the next couple of years as a result of all the Fed's policy tightening in order to get rid of inflation. And I think inflation is going to prove stickier and harder to combat. Yes, the market had a nice reaction to yesterday's number, but don't think that means that the inflation story is over or that we are necessarily in a bull market. Now, what would make me wrong about this would be if investor expectations turn out to be correct. If investor expectations turn out to be correct and inflation really does go away tomorrow, I will eat crow and I will be wrong. And the stock market could potentially go on to support really high levels of valuation as bond yields potentially come back down. It's a beautiful story. I don't know whether I believe the bond market story. I'm more inclined to look at the data, and the data suggests to me inflation might be around for a while longer yet, and that can be very troubling for the equity market. So that's my view of the stock market and how it relates to the economy, how it relates to bond markets, et cetera. I think we have a good solid 15 minutes here for any questions that you might have for me.
Thank you, Erik, for the talk. Yeah, so if there are any questions, you all can add it in the chat box and we can discuss it right now.
Would you like me to stop sharing the presentation?
Yes, I think that'll be fine.
Okay, good. Yeah, there we go. Now we can see each other more easily.
Yeah. Just think we'll wait for people to post questions. There's a question, if you can see, Erik.
Oh, yeah.
Yeah.
Okay, let me, oh, I see. Yeah, okay, I have to open up the Q&A chat box window here. So just give me a second. It's circling. It's going to give me the question, but you can read it to me too if you want.
Yeah, sure. Assuming this bear market continues, is there a macro situation you would look for to pick the bottom?
Oh, yeah. Picking bottoms is extremely difficult work. I would, but there is one thing though I think is typically a good indicator when you're at bottom, and that is when you have a flight to quality rally in bonds. So typically when the equity market is close to hitting bottom, the sell-off becomes so extreme and so severe that it causes people to dump equities and to move that cash into government bonds. And so you wind up with a really, really big rally in the government bond market. And that is something we have absolutely not seen happen yet. Even on the worst down days for the equity market, the bond market often goes down as well. And that is an indicator to me that we are not at the bottom. I could be wrong. If inflation goes away, I'll be wrong. But if inflation proves stickier, like I think it will be, it's a sign that we're not near the bottom. My fear is the way in which this ends is the stock market has such a severe sell-off that it forces the Federal Reserve to make the following choice, to choose between financial stability and fighting inflation. And if faced with that choice, the Federal Reserve will always choose financial stability. So if we have a really big sell-off in the equity market, the Federal Reserve will eventually say, okay, we're either going to stop raising rates or maybe we'll actually cut rates. And when they do that, you could have a huge rally in stocks, a huge rally in gold, and probably a huge drop in the bond market. But we just haven't seen that happen yet. But I fear it might be coming for some time next year.
Yeah. We have one more question. Which investments are better, individual equity stocks or ETFs?
Or ETFs? Yeah, I think it really depends. I mean, if you are investing, what I like about ETFs, just like what I like about futures on the S&P, et cetera, is that they give you an exposure to a huge range of stocks. So it essentially gets rid of the stock-specific risk. So it really depends. If you're more of a macro trader, and I tend to view things more in a macro sense, I prefer investing through ETFs for that, or through futures, because you get a huge range of stocks that can respond to macroeconomic events. But if you choose individual stocks, like that can be okay too, but you're essentially taking a lot of individual company risk. So if it's an industry you know a lot about, or you feel like you have some sort of advantage in choosing one stock versus another, then that can be fine. But it's not really my thing. I'm not really a stock picker.
Okay. Do we have any more questions? I don't see anything on my end. Yeah, that's what. The Mississippi River levels are low. Mark is saying that.
I'm sorry, I didn't quite hear.
The Mississippi River levels are low.
The vol levels?
Sorry, what?
The volatility levels are low?
Yeah, I think.
No, I think it's actually said about the Mississippi River levels, which is impacting the trade flow.
Oh, yeah. So this has been very problematic. The United States is experiencing a really bad drought. So the river levels of the Mississippi have fallen down to levels that are so low, it's actually difficult to navigate in the river. So this is creating a lot of problems in the U.S. Because there's a lot of water transportation through the Mississippi, particularly for agricultural goods like corn, wheat, and soybeans, often transit the river on their way down to the port of New Orleans, where they're exported to the rest of the world. So this has been creating problems. But we've been seeing just crazy weather events all over the world. I mean, Florida was devastated by a hurricane. We have terrible flooding in Pakistan, flooding in Australia. We had a drought here in Western Europe for a while, but thankfully is being somewhat alleviated recently. We've seen droughts in South America, droughts in China. There's a lot of very, very concerning weather events. One sector of the market I'd be very worried about right now would be insurance companies. Insurance companies are on the hook for a lot of this stuff, and that their stocks might be vulnerable, especially vulnerable to climate change and to extreme weather events.
Are there any more questions?
I'll ask you one, Erik.
Okay.
So obviously you talked about the workforce and the problems that you've got 10 million open jobs in the US at the moment and full employment. Do the US need to change their immigration laws again to actually allow workers in?
Well, this is a question we hear a lot. I mean, we have labor shortages here in the United Kingdom. There are labor shortages in Japan, labor shortages throughout much of the Eurozone. So, I mean, I guess the simple answer is like in a logical economic world, it would make sense to open countries up to immigration. But by the same time, voters across the European Union and across, certainly here in Britain with Brexit, in the United States, have sent a very clear message that they don't want more immigrants. I don't know. I mean, I think it depends from one country to another, but in the United States, we've been very cyclical about immigration over the course of our history. People think of America as a country of immigrants, and that's kind of true. It's not false. But there have been periods in the past when we had very high rates of immigration, particularly in the early 1900s. Just droves of people arrived from Eastern European countries like Poland, Southern European countries like Italy, and it provoked a massive political backlash. So in the 1920s, the Republicans dominated politics, and they shut down the country to immigration almost completely in 1924, and it stayed shut for 4 decades until the mid-1960s, when it gradually started opening up again. And then we started getting this huge surge of immigrants in, and then, of course, we wound up with the Trump phenomenon, like build the wall, make America great again. The United States is still processing that. Here in Europe, we also see a very similar phenomenon. You see the rise of the far right in every European country. The National Front in France, Vox in Spain, the Swedish Democrats, the Alternative for Deutschland. Having more immigrants would solve a lot of economic problems. It would also benefit things like Social Security, like all of the state systems that sort of require on ever larger numbers of workers to support these huge retiring populations. But the problem is it's run up against a wall of political reality, which is that voters have kind of decided that society just can't integrate any more immigrants than it already has. And so it's a really difficult question. You see the same thing in Japan. Like Japan is a country that doesn't deal very well with immigrants either. They actually do have immigrants from Korea who traditionally they've treated quite badly. And so Japan is also like a society that maybe could use immigrants. They have a declining population, but it's like almost unimaginable in the Japanese psyche. You would throw the doors open and allow like substantial numbers of new people to come in. One exception might be the UAE. Now, that's a real country of immigrants.
Only 92% of us are immigrants.
Only 92, yes. See, the U.S. freaks out when the percentage of immigrants gets up to like 10 or 20%. Then they call in the Republicans and shut the borders. But not every country can do 92% net immigration.
But I think the demographic problem is going to be just as big everywhere else, because if you look at China and everywhere else where you have aging populations, but you don't have the level of youth coming through, so the kind of the ratios have changed in such a large way, it's going to have a major impact on what we're looking at over the next 10, 15 years.
Yeah, and it could be very, very inflationary as well. Part of the reason why inflation fell so much in the 80s, 90s, and 2010, the early 2000s was that we had this huge pool of available labor. But now that pool is mostly gone from China. It's certainly gone from the West. The only countries that really have really high birth rates still and still have a lot of young people are the Indian subcontinent countries like Pakistan, India, Bangladesh, Sri Lanka, and countries in Africa. But everybody else has really low birth rates, and it's going to put a lot of upward pressure on wages. Which means this period of low inflation might be permanently gone, especially as we experience deglobalization. Like the anti-immigrant phenomenon is just one symptom of deglobalization. And deglobalization, moving supply lines out of China to other countries, putting up trade barriers and trade tariffs, that's very inflationary.
Okay, there's one more question for you. Sector rotation into defensive stocks like Home Depot will weather the bear market? What do you think?
Yeah. Typically, defensive stocks do better. It can be a complex phenomenon. Some defensive stocks are high dividend stocks, and so high dividend stocks typically don't like higher interest rates because they're sort of almost like bond-like stocks. And so I think it depends. I mean, Home Depot does rely a lot on consumer spending and home improvement. So as mortgage rates soar, there's going to be a lot fewer people who are able to take out home loans. That might reduce their demand for doing kind of like around the house building work that is sort of the mainstay of Home Depot's business. Yeah, it's a complex question, but I think that there will inevitably be sectors that outperform. Once in recent months, among the outperformers have been energy and material stocks. Those stocks have been doing relatively well since the bear market began for the rest of the stock market. But the one sector that worries me the most is the technology sector in the U.S. When I look at companies like Tesla, and I think, okay, this dude, Elon Musk, he just flushed $44 billion down the drain as he destroys Twitter. I think Tesla's way overvalued. I think, a lot of these companies like Meta, I think despite its decline, is still hugely overvalued. There's a lot of tech sector stocks they would just avoid like the plague.
Okay, I think that's it from the audience, but we had a very good and deep question and round session.
All right. Well, thank you so much. It was really a pleasure. I look forward to the next time.
Yeah, thank you so much. In fact, I would also like to thank even though Victoria and Clive are not here, but
I see Clive.
Clive is here.
Nice here.
Okay. So thanks
Erik,
everyone.
Erik,
Yeah, thanks
so much thank you so much from all of us at APM. I hope everybody who's joined and has taken something away from this. And as it actually says, we really look forward to the next one. It's been a real pleasure. So enjoy your weekend.
All right. Thank you so much. Cheers.
Thank you, everyone. See you.
Thank you, everybody, for joining.
Thank you. Bye.
Bye. Thank you, everyone, who attended the webinar.